Against the backdrop of the conversations of last week, we've got Hippos, and Bruce's introduction speaks to this extraordinary recovery in markets, which we could call Herculean, to borrow from the storyboard of the supplementary budget. And against the intro of the impacts of COVID on economies, on budgets, the dive in markets and the recovery, I've got a first picture which I think is helpful in capturing the immediate impact on the bellwether asset class, which is business. And the data that you see here shows the relationship between world economic growth, that's the gray columns, and the blue line is capturing the implications for business bottom line performance. They don't map quite one-to-one, but in the world of business and finance, they travel together. They're good colleagues. And that where you find the economy enjoying buoyancy, you tend to find businesses enjoying buoyancy. And you've seen this ride over the recent past. If I step across here to what's going on in the 2020 environment, this mining in the gray column is the spectacular step down in world economic growth. And the implication for the blue line company earnings is that they take a dive of about 70%. So our suspicion is that based on what's going on in the world economy, headline company earnings, the MSCI All World Index being the barometer, that world index is going to experience a 70% decline in earnings. Of course, there's a recovery on its way in 2021, but we're not there yet. And on our way to there, we must first be South African. So let me show you the exact same data for South Africa. And conveniently, and not by accident, the data shows a similar type of relationship. That the gray column, South Africa's economic growth, and the blue line, the bottom line earnings performance of all JSE listed companies, shows us, like the global story, that 2020 is going to be a deep dive into an economic hole. Kevin spoke about the size of the decline. We've got penciled in a 10% decline in GDP, and a 10% decline in GDP will take company earnings down into this deep V. If you have a look at the chart on the right-hand side, we're measuring here the implication for company earnings. And what's notable is that in the case of South Africa, whilst we expect global earnings to fall by as much as 70%, South African earnings only fall by 30%. Now, how on earth could that happen given the fragility and vulnerability of the domestic environment? And we've got a cocktail of three things that defend or provide some immunity to South African earnings. The first is that the rand has weakened from 14 to 17, and about 60% of South African earnings are dollar denominated, so there's a pass-through effect. The second is the extraordinary bounce in commodities, and with commodity prices making up a large basket of the JSE earnings composite, there's some relief in there. And then the third is what we've termed the Naspers effect, that there is a large part of the JSE that just isn't in South Africa. So there is some resilience and maybe even a modest silver lining in the South African story. What that doesn't take away from, though, is the deep stress and even distress of many South African businesses. And we think that we're just at the early start of that storyboard, that the second part of the year is going to translate into far more evidence materializing on liquidations, insolvencies, and companies going into business rescue. The standout feature in the environment is the coordinated and extensive policy programs that have been put together, not just in the United States, globally. If you take a look at the size of the policy packages that were put together, global financial crisis, that's the solid black blocks. And then the outline blocks is the packages that have been put together under COVID-19. These absolutely tower over the global financial crisis packages. So not only are the packages by country substantially bigger than global financial crisis, they are also coordinated, that there's monetary and fiscal policy going on together, and then it is happening about as universal as you can get. And that is translated into a suspicion that we will have a V-shaped recovery. We are circumspect on the V-shaped recovery. We don't think that the recovery is going to be either quick or easy. And on this set of charts, I'm showing you some data from South Africa. On this side, you've got data from Hyprop, the property business, which shows you footfall traffic in malls in South Africa. And there is a big recovery from the dark days of April, but it's a long way up still to achieving above water. And keep in mind that this is footfall, it's not revenue. And then on this side, we've got spend in large Chinese cities, and we've got air traffic in China. The blue line is international traffic, the black line is domestic traffic. So the Chinese internal or domestic economy is showing some signs of buoyancy, but none of these look like a V to us. They look U-ish or even gentle L. And given that, notwithstanding the substantial policy packages, we think it equips us from an investment perspective to be circumspect about market recoveries. And markets have walked on from this as if there's nothing to see. A colleague put onto Twitter recently a very quirky chirp where he said, I went offline in January, the S&P was at 3,000. I've been offline for a couple of months. I'm back, I see the markets where it was at the start of the year. Has anything interesting happened? I think that's the headline narrative going on in markets is walking on as if there's nothing to see here, folks. And there's a lot to see because that news is still coming down the line in the form of balance sheet stress. You don't want to confuse accounting numbers with cash flow. And the sentiment has got a long way ahead of the market reality. There are some ways in which we could forgive this valuation. For instance, pointing out that interest rates are zero, and so that should give you very buoyant equity valuations. And that, after all, this is just one bad year. And when you're buying a business, you're not buying a year, you're buying a future of many, many years. But in this vein, South Africa has also responded, even against the backdrop of an exceptionally tough budget or supplementary budget. The Rand finished last week stronger than it started. The bond market finished the week stronger than it started. And there's a suggestion from capital markets that maybe this task isn't as Herculean and we shouldn't be so scared of the hippopotamus. We are circumspect and cynical, because what is required to justify these valuations is extraordinary structural adjustment on the part of policymakers, and there isn't much evidence yet to suggest or to convince us that this is likely to happen. In terms of investment implications, a standout feature in reading through the data is the chart that I've got on screen here. The spotted line shows you South Africa's domestic savings as a percentage of GDP. And the solid line, the lower one, is South Africa's budget deficit. And for a long time, we've got sufficient savings to fund our budget deficit. What happens now in this year is the two touch each other, and what that tells you is that all domestic savings must be allocated to fill the budget deficit. Now, that's not going to happen financially or fiscally, but it shows you just how substantial the strain is on the system. That in essence, the entire domestic savings pool must be allocated to fill the budget deficit. Given that reading, South Africa has some redeeming features, one of which is our very, very deep capital markets. And those deep capital markets are backed up further by a pension fund industry, which constitutes about 5 trillion rand in savings, 100% of GDP. This quickly takes us to a conversation about the possibility for prescribed assets. And prescribed assets looks like a growing risk, that for a long time South Africa has had insufficient savings to fund investment and insufficient investment to fund growth. So the conversation is shifting to suggest that this is a structural reform that is needed, and that policymakers need to step into the frame. There's going to have to be a whole lot of financial and fiscal juggling going on. What does it mean then for investors? Here's a couple of headlines. Domestically, we think that there is a risk that the fiscus will go for marginal tax creep, perhaps in the form of CGT or a wealth tax, that the recovery in company growth and performance hinges on economic recovery, and we've already put a question mark over the nature and extent of that. That the rand is undervalued and bonds actually look attractive, but there are massive caveats in either allocating to the rand or domestic bonds. And that real estate, which for a long time has been a darling of South African investors, is held back by supply and demand dynamics. Globally, there's a freeze on interest rates, which means cash and bonds overwhelmingly are uninteresting. The dollar is expensive. And always in investing, it's not about where the returns, but where are the risks. And so rather than thinking about individual asset classes, we think that the world is thinking about all asset classes. So not US or China, but US and China. Not growth or gold, but growth and gold. Not resources or healthcare, but resources and healthcare. And then thematically on this slide, we've got some pictures of businesses that have demonstrated the ability to pivot and achieve impact. And we think that's an important feature of ways in which you think about allocating assets in a post-COVID world.
Very neatly dodged on the main question here, Dr. Saville. Very neatly dodged. Very neatly dodged.
Well, then that would make me a good economist.
What are we meant to advise? Exactly. You can go, if this doesn't work out, by the way, I was watching you, you could become a great weatherman or a rugby commentator. Now, give me a sense, please, as to how we calm down people. And I mean, these are financial advisors who are watching us today, who have got people who are absolutely petrified of the future. How do we talk to people about allocating money in this environment? More South Africa, where valuations are glorious and cheap and terrifying, to the United States, where valuations are glorious and expensive and terrifying, to Europe, where pretty much the same sort of picture lies. I mean, is it time to sell everything, to put it in gold and to put it in the basement? What is the bottom line on this?
So Bruce, my last point was that is exactly the very last thing you want to be doing, is trying to choose the winning asset class. In the world of investing, one of the free lunches that you get is diversification. And if ever there were an environment in which you want to be diversifying, this is it. So in thinking about your portfolio construction and how you manage your clients' positions, I think there are two key elements never to let go of. The first is investing always starts with managing risk. You worry about risk first. If you forget about risk, then returns are academic. They'll get blown out the window at some point. So start with risk management, and then the returns will look after themselves. The second is never lose sight of the discipline of investing. And investing boils down to building portfolios where the asset exposure matches the appetite of clients in terms of their risk frameworks, their investment horizons, not confusing accounting with cash flow. In this environment, placing particular emphasis on the strength of balance sheets. And if you put those ingredients into the cocktail and then hold the discipline of investing, keep your investment plan in place. Being sensitive always to people's changed circumstances, but to your fullest possible extent, stay with your investment plan. And if you can keep those ingredients in the cocktail, you're in the best possible shape I think you can be in a very, very stressed environment.
I mean, in the olden days, which was, 3 months ago, you could buy the MSCI World Index. I mean, you would get all the diversification that you needed. But a bit like South Africa has become massively biased to Naspers and Prosus, the MSCI World Index is massively exposed now to the S&P 500 because of its valuation. The S&P 500, in turn, is massively exposed to the big 5 FANG stocks. And suddenly, if you're investing in the MSCI World Index, you're actually about, 40-50% exposed suddenly to the biggest 5 shares in America. And that scares the living daylights out of me.
But there's parts of the world market that are A, concentrated, and then that's not risk management, and B, very expensive, which is not investing. So you always want to be thinking about what am I exposed to. The point you make is spot on. If I buy an index, am I really getting diversification? You've made that comment for the JSE, which is a very concentrated index. So there's lots of ways in which you can manage or mitigate this risk. By way of example, instead of buying a market-weighted index, you buy an equal-weighted index. So all the companies that make up the top 40 index would carry 2.5%. Suddenly you've got a much more diversified index. So that's one way of managing the diversification. And then thinking about the valuation, you're absolutely spot on. The US market, for instance, and the dollar look expensive. So there's some interesting other markets that are substantial and competitive. Germany and South Korea stand out as great cases in point. And the way that I imagine you can think about this and get rid of all of your biases and emotions in investment decision making, which are our biggest enemies, is imagine you lived on Mars. Don't imagine yourself South African. Imagine you lived on Mars. If you lived on Mars, how would you allocate capital?